I'm looking at S&P 500 of 4,100. I believe your call is about 4,300 in the next 6 months as inflation and peak Fed hawkishness really kicks in. How much of the recession story is already taken into account from the carnage of 2022?
Well, certainly in Fed rate futures and even to an extent in the bond market, whether it's 10-year TIPS yield dropping from about 1.8 to 1.0 or the Treasury yield falling well below 4%, that slowdown is being baked in. But we think this market will peak out by mid-year, so May-June timeframe. I don't really want to be in front of what I think is going to be a very, very contentious debt ceiling debate. Both sides believe that they are, have a good point and that they're entrenched. And this will come down absolutely to the last hour. And so that could cause volatility as it did 10 years ago.
Barry, what does that look like then? I mean, we're talking about June here when that debt ceiling debate really hits the final hour or minutes before we hit that debt ceiling. What is the trade as we have that conversation?
I think this year is going to look like an upside-down U. The rally we called last October will expend itself around mid-year, and then we'll start to roll over into the summer, and I do expect the fourth quarter will be down. All of our models said there would be no recession, and it's been saying that for many months, no recession until around September of 23. So typically the market in the 12 recessions since World War II fell almost exactly coincident with the starting date of a recession, which was then declared several months later, but after the market had already reacted. I think that the risk for economic growth and the risk of rising unemployment and so forth is really skewed into the late summer, early fall. So I am expecting that kind of upside-down U-shaped year where a more cyclical posture leads you into the middle of the year and then a more defensive posture towards the very end of the year.